TK Corporation completely crushed consensus this quarter. I mean, we are talking Q2 2026 revenues of $379.1 million and a GAAP net income of $69.5 million, which is about 79 cents a share. But the real headline here is their subsidiary, Teekay Tankers, bringing in a massive $5.56 in adjusted EPS on $194 million in adjusted net income. The stock is reacting exactly how you'd expect to a historic beat like that, and their Q3 guidance is pointing to continued sky-high spot rates.
Yeah, it's honestly a phenomenal set of numbers. I mean, the maritime shipping industry is usually this incredibly volatile boom and bust cycle. You build too many ships, the rates crash, you scrap them, rates spike. But these earnings, they paint a picture of a very specific structural boom grounded in physical bottlenecks. The market is just fundamentally squeezed right now.
It really is. So to get to the bottom of this squeeze for you today, we're working from the official Q2 2026 earnings presentation and the TK press release from July 29th and 30th. Our mission today is to unpack how these unique global dynamics created this record-breaking quarter for mid-sized crude tankers.
Exactly, and we really want you to understand how TK is capitalizing on this aging global fleet to basically print money and how they're planning for the future.
Okay, let's unpack this. Going back to those numbers, the gap between the parent company and the subsidiary is pretty wild. Like $70 million GAAP net income for the parent, but almost $200 million adjusted for the subsidiary. What are we actually adjusting for there?
Well, that distinction is totally crucial for understanding their core business. GAAP accounting includes everything, right? So operating revenue, but also one-time events like selling a ship.
Oh, okay, so it's a bit noisy.
Exactly, it's accounting noise. If you want to know how much cash the actual business of moving oil is generating, you look at the adjusted net income for TK Tankers, ticker TNK. When you strip out the one-offs, that $194 million is pure operating profit in just 90 days. It's the highest in their entire history.
Which is just astronomical. And that cash comes directly from the daily spot rates they're charging. We should probably clarify what ships we're talking about first, right? They mentioned Suezmax, Aframax, and LR2s.
Yeah, so a Suezmax is this massive vessel, like 3 football fields long. It's the maximum size that can fit through the Suez Canal, fully loaded, carrying about 1 million barrels of crude oil.
Wow, 1 million barrels. And the others?
Aframaxes are a bit smaller, like 600,000 barrels, so they're versatile for smaller ports. And LR2s are similar in size, but usually coated to carry refined products like jet fuel, though they can do crude too.
Got it. So for those million-barrel Suezmax behemoths, TK averaged $109,200 a day in Q2, and the smaller ones averaged $74,100 a day.
Which is just staggering when you think about it.
It's like surge pricing on an Uber during a massive storm, but the storm lasts for months and all the cars are 15 years old. People just have to get home, so they pay it.
That surge pricing analogy is perfect for the spot market. Opposed to a time charter where you lock in a lower, safe rate for years. TK kept their ships in the spot market, completely exposed to that upside.
Right, because if an oil company has 1 million barrels sitting there racking up storage fees, they're desperate. They'll pay the $109,000 a day just to move it.
Exactly. Any ship owner with a vessel in the right ocean at the right time is seeing an immediate, massive cash surge.
And these rates shattered the previous Q1 2023 record by like $30,000 a day. They didn't just beat it, they totally obliterated it. So what actually happened in the macro landscape to make renting a tanker so insanely expensive?
Well, it comes down to a massive structural squeeze in the physical supply of ships. The presentation uses Clarkson's data to show 2 colliding forces. First, the current global fleet has the highest average age in over 30 years.
Wait, really? So the steel moving the oil is older than it's been since the 90s?
Yeah, exactly. And at the exact same time, the shipbuilding industry has the largest order book in 15 years.
Okay, so a huge backlog of new ships being ordered.
Right. What's fascinating here is the paradox it creates. Everyone knows the fleet is old, so they rush to order new ships. But you can't just speed up a shipyard like an assembly line.
Because you need massive dry docks and specialized steel and labor in places like South Korea and China. Bam.
Exactly. And those yards are totally booked up with LNG carriers and container ships. So if you order an oil tanker today, you are taking a ticket and waiting till 2027 or 2028.
So we're stuck relying on aging ships while we wait years for the new ones. But wait, let me push back on this a bit. If the fleet is the oldest in 30 years, doesn't that mean these ships are increasingly terrible and expensive to run?
Oh, for sure. They have older engine technology, like more hull fouling, which creates drag.
Right, so they burn more fuel and need heavy maintenance just to stay afloat. How on earth are they making record profits on inefficient equipment? That seems totally counterintuitive. Wouldn't maintenance eat all the margins?
On paper, yeah, your logic is totally sound. They are way more costly to maintain, but the sheer inelasticity of supply and demand just completely overrides those operational costs right now. Well, imagine you're a logistics director for a major energy firm. You have an $80 million cargo of crude that needs to be refined in Europe, and there are literally no available ships in the region.
So you just pay whatever it takes, regardless of how old or inefficient the ship is.
Precisely. Because halting production or maxing out your onshore storage costs way more. The extra fuel for an old Suezmax might be a few $1,000s a day in operating expenses.
What, the spot rate jumped by $30,000 a day because of the shortage.
Right. So those inefficiencies are totally dwarfed by the massive influx of revenue. Once the $20,000 to $30,000 daily break-even is covered, almost every single extra dollar drops straight to the bottom line as pure profit.
Okay, that makes perfect sense. The charterer's desperation funds the asset's inefficiency. But you can't run old ships forever no matter how much they earn. So looking at TK's fleet renewal plan in this presentation, they are pulling off a masterclass in capital recycling.
Oh, absolutely. They know these high asset values won't last forever, so they're actively selling off older tonnage into this desperate secondhand market.
Yeah, going back to the car analogy, it's like selling your 15-year-old car for an absolute premium because no one can find a vehicle today, and then custom ordering a new one. They sold a 2009 Suezmax in Q2 for a $32.3 million gain.
And just to be clear, that's not revenue from moving oil. That is $32.3 million in pure profit just from handing over the keys to a 17-year-old ship.
That's wild. And they followed that up by selling a 2013 VLCC in Q3 for another estimated $22.9 million gain.
Right, so they walk away with over $55 million in profit just from asset sales. And they're aggressively taking that capital and reinvesting it into new, highly efficient vessels.
Like the two Korean Suezmax new builds they ordered for $190 million, delivering in 2027. But wait, if they drop $190 million on new ships today, doesn't that take a huge bite out of their current cash reserves?
Well, no, because of how shipbuilding contracts actually work. They don't write one massive check today. The payments are heavily staggered.
Oh, I see.
Yeah, the appendix shows they make smaller installments through the back half of 2026 and early 2027. But the massive final chunk, like over $121 million, isn't actually due until the ships are physically delivered in late 2027.
So it's incredibly cash flow efficient. They get to keep their cash buffer today, earning interest, while still legally securing future assets. Plus, they bought three 2016 Aframaxes for $141.5 million back in January, and those just came off their bareboat charters.
Yes, and that redelivery is a really important detail.
Remind us what a bareboat charter is and why taking them off it matters.
A bareboat charter is when you basically just lease the physical ship, the bareboat, to a third party for a fixed daily rate. They supply their own crew, pay for their own fuel, and take all the risk.
So it's very safe, but relatively low margin.
Exactly. By redelivering them, TK takes back full operational control. They put their own crews on and put those three ships directly into the hotspot market.
So they traded that safe, low rate for full exposure to the $74,000 a day Aframax market, just maximizing cash generation today while prepping for tomorrow.
Which bridges us to the bottom line for the listener. With all these moves, what does this actually mean for the balance sheet going into next quarter?
The result is that TK has a fortress balance sheet. If we look at TK Tankers, they ended Q2 with an incredible $1.215 billion in cash and short-term investments. That is a massive war chest.
$1 billion in liquidity is insane, and the parent company holds $56.4 million in cash plus 10.6 million shares of TNK. That equity alone was valued at over $690 million at the end of Q2.
Yeah, they are just sitting on a mountain of liquidity.
Yeah.
And they're making sure to reward investors for
Right,
it.
big time. The press release notes TK Corp paid a $1 per share special dividend in June, returning $87.4 million total to shareholders, and TK Tankers declared a regular 25-cent quarterly dividend. It's a very clear signal of confidence from management, but, as analysts, we also have to look at the immediate horizon for headwinds. And their Q3 outlook predicts a decrease of 236 net revenue days compared to Q2.
Now, fewer revenue days sounds terrible at first glance. Less time out on the water capturing those massive rates.
Yeah.
But the report says it's primarily because of those profitable vessel sales and an increase in scheduled dry dockings.
Right, and dry docking is this mandatory heavy industrial maintenance. You literally take a 900-foot steel behemoth, pull it out of the ocean and put it on concrete blocks.
Just to scrape the hull and fix internal valves and stuff.
Yeah, scrape the hull, apply anti-fouling paint, major inspections. It takes weeks and costs a fortune. And crucially, the ship earns zero revenue during that time.
Which brings us back to that billion-dollar balance sheet. A highly leveraged company would be financially crippled by that off-hire time, but TK can just absorb it.
That's the synthesis of the whole strategy. They have the cash to take the hit on revenue days now. Furthermore, while they have fewer days available in Q3, the spot rates for the days they are trading remain incredibly robust.
Right. The report showed Suezmax rates were still averaging $104,800 a day in July for the 44% of spot days they had booked so far. They're basically taking a necessary pit stop to change the tires while they're miles ahead of the pack.
Exactly. Sacrificing a fraction of capacity today to make sure the fleet is perfect for the winter squeeze. Holding zero net debt gives them the operating leverage to just make those long-term decisions.
So let's summarize exactly where we stand for everyone listening. You are now fully caught up on how supply bottlenecks and a 30-year-old global fleet are forcing charterers to pay surge pricing.
Wow.
We saw TK tankers pulling nearly $200 million in adjusted net income in a single 90-day window.
And we mapped out how management is aggressively recycling that capital, selling old assets at a premium, acquiring state-of-the-art vessels for 2027, and returning millions to shareholders.
All while sitting on a billion-dollar liquidity buffer. But looking ahead, there's one final provocative thought we want to leave you with, based on the forward-looking statements in the presentation. Management explicitly calls out upcoming environmental regulations.
Yeah, specifically they highlight the European Union emissions trading system and the looming FuelEU maritime regulation. It's a huge operational factor.
Right. And again, we're not here to debate the politics of climate change, but strictly from a market mechanics perspective, these EU regulations put hard financial penalties on every ton of carbon burned in European waters.
Which is a massive deal when we just established that the global fleet is the oldest it's been in 30 years. Old engines burn more fuel and emit way more carbon.
Exactly. So here's the question for you to mull over as we wrap up. A physical and regulatory clash is clearly imminent. With strict EU emissions limits coming into force, will shipping companies like Teekay be able to bridge the gap with their 2027 new builds fast enough? Or will the global reliance on these aging, high-emission ships cause an unprecedented regulatory bottleneck where there just aren't enough legally compliant ships available to move the world's oil?
Finding that equilibrium is the defining challenge for the next decade of maritime shipping. The companies with cash to adapt will thrive, and those burdened by old fleets and high debt will be completely squeezed out.
It's definitely a massive structural shift to chew on as you watch the markets. Thanks for taking this deep dive into the mechanics and the numbers with us. Be sure to follow the show for daily earnings coverage to stay ahead of the curve. Catch you next time.